So you're new to the world of investing. You've watched a couple of YouTube videos on the long-term benefits of investing your cash, and you've made some commitments in your head to start saving for the future. Good stuff. But I know what you're thinking. What do I even invest in, and how do I figure out what investment is right for me? A fair question, and hopefully one that you'll get closer to answering by watching this video. One of the first and foremost priorities of any financial advisor when recommending a financial product to one of their clients is to ensure that the financial product that they're recommending is suitable to the client in question. This requirement is in fact imposed by law, and is just one of the ways in which state bodies attempt to prevent their citizens from being exploited by financial malpractice. Now, that being said, I'm not a qualified financial advisor, and as you know, the videos on this channel are for educational and entertainment purposes only. However, I thought what we could do today is to take a look at some of the considerations that are taken on board when assessing the suitability of an investment product for an individual. The reason why I want to do that is because it should give you some reference points as to what you should be considering when trying to figure out what it is you should invest in. How's it going, everyone? My name is Dan, but you can call me Malone, and today we're going to try and get you closer to answering the question that's in the head of every investor who's new to investing. Where do I even begin? I'm going to show you that the beginning point of your investing journey is in fact not an investment purchase at all, but rather a self-analysis which will allow you to craft an investing strategy which is suited to your needs. Every investment must have a purpose, the most obvious of which is to make money. But what you need to understand is that different types of investments will be suited to different types of people, depending on a wide range of considerations which we'll discuss in this video. And your priority should be choosing the investment which is best suited to you, having accounted for each of those considerations. But before we begin, as always, if I could ask you to please leave a like on the video. Liking the video really does help me out a lot, as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And if you are new around here, please do consider hitting that red subscribe button below and hitting the bell for video notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. The first consideration you need to take on board is your needs and objectives. Things to consider here will be the likes of how long you intend on holding your investments for and what your immediate need for cash looks like. For most individuals, the best port of call when it comes to investment duration and general investment strategy is going to be one which involves regular, consistent investments over a long period of time. For me, my investment strategy is to slowly build a portfolio of well-diversified investments, which over time will hopefully grow into a large pool of capital, which I can then draw on as I see fit. And as of right now, that investment strategy works for me because my immediate need for cash is quite low, in the sense that I know that I won't need the cash that I invest into my portfolio anytime soon. But this may not be the case for you for any number of reasons. For example, you may have existing loans or debts which are eating up your available cash flow. You may have financial commitments such as rental costs which need to be paid, or you might just like to have more cash in your bank account for safety reasons. So that's why it's important that the investments that you ultimately end up putting your cash into make sense in the context of your needs and objectives. There's no point investing in the likes of the S&P 500 if you're not willing to invest consistently over a long period of time, or even if you believe that you'll need to access the cash that you invested anytime in the near future. Reason being is that your investment won't be given enough time to appreciate in value or compound on itself via dividend reinvestment. I've made it no secret on this channel that I'm a big proponent of longer term investment strategies, and I don't engage in any day trading activities. That's not to say that you can't make money in doing so, but it is in my opinion a harder feat to achieve, especially if we're talking about consistent growth year over year. So for most individuals who are starting out investing, I would be confident in saying that the more realistic investment objective should and would be slow and consistent growth year over year, rather than any investment strategies which are akin to get rich quick mentalities. And as well as that, you need to figure out how much of an investment makes sense in the context of your immediate need for cash. I previously made a video on cash management and how to make the most out of your cash, so I'd recommend checking that out in order to determine the optimal amount to invest. Long story short, just like how you should only invest in products which match your investment objectives and time horizon, you should only invest a sum of money the value of which makes sense in the context of your current and likely future need for cash. The second consideration is personal circumstances. Before we discuss this one, you can see how individualistic the investment decision is. is? The answers to each of these considerations are likely going to vary greatly from person to person, and that's why you can't really just paint everyone with the same brush when it comes to deciding which investments and investment strategies are best suited to any given individual. So with personal circumstances, you need to account for things such as your age, your employment status, any known changes to your circumstances in the future, and the level of knowledge that you have, not only when it comes to investing, but also when looking at your financial literacy as a whole. All of these factors contribute to your investment decision in different ways. Generally speaking, the older you are, the less investment risk you can afford to take on, or rather, it's less advisable to take on higher levels of risk as you get older. Reason being is that you have less time than a younger person until you reach retirement, which is when your portfolio will likely be drawn on. So therefore, you have less time to recoup any losses arising from heightened levels of volatility associated with riskier assets. With respect about your employment status and any future changes in your circumstances, this relates primarily to considerations around your main source of earned income, i.e., is your current employment from which you earn a salary a stable source of income, and do you foresee any changes in that fact in the future? This is important for obvious reasons. Any sort of uncertainty around your regular income stream will increase your current and likely future need for cash, and will therefore reduce the amount of cash that you have available for reinvestment. Furthermore, even if your employment is stable at the moment, any doubts about your future may result in you being less willing to tie up your cash in investment assets. And as for knowledge, experience, and overall financial education, I've said it before on previous videos on the channel that I'm a big believer in the fact that the level of financial literacy that you personally have will directly impact any returns that you achieve or hope to achieve in your investment activities. This is because having that bedrock of financial know-how will not only allow you to capitalize on opportunities, but it will also prevent you from making any mistakes which can result in catastrophic losses. So in the context of your personal circumstances, if you don't have a high level of financial literacy and have no intentions of taking any active steps in changing that fact, then that's okay, but you'll just need to manage your expectations as to what kind of returns you can expect to see on your investments. The third consideration is financial situation. We've already taken a look at considerations around your immediate need for cash, as well as the stability of your primary source of earned income. So with financial situation, we're more so concerned with the actual level of regular income that you're receiving from your employment, as well as any investments or savings that you've made to date. In an ideal scenario, the extent to which you can commit cash to investments should increase as your salary increases. Effectively, the more cash you earn, the more you should have available for reinvestment. However, oftentimes this isn't the case, because a lot of people in reality end up taking on more and more liabilities the more that they earn. People are essentially in a zero-sum game with themselves, in that any increases in the amount that they earn are automatically offset by the additional liabilities that they take on. And this is one of the critical errors and misinterpretations that people make when it comes to building wealth. The amount that you earn is irrelevant. It's what you're left with after accounting for your expenses that matters. And if your money isn't being invested in productive assets which generate cash flow as you sleep, then you're not generating true wealth. So in assessing your financial situation, of course you need to take account of how much you earn, but you should also look at how much progress you've made to date in building true wealth. And for the vast majority of new investors, that progress is going to be little to none. And that's okay, everyone has to start somewhere. But it's more so important that you realize that your investment success will be largely dependent on your ability to scale your investments over time as your salary increases. Having that understanding is very important, especially for new investors. And if you can wrap your head around analyzing your own personal financial situation, then you'll be far better positioned to determine which investment strategies and what investment products you want to pursue. The fourth and final consideration for today's video is attitude to risk. The general principle here is relatively simple. You shouldn't invest in assets which don't match up with your own personal tolerance for risk. Nobody likes the thought of losing money and receiving an amount back that is less than the amount that you initially invested. But of course, different people will have different levels of acceptability when it comes to their willingness to take on a certain degree of risk in order to obtain a potentially higher return on investment. However, you can't expect to be able to assess your attitude to risk until you fully understand the various types of risks associated with investing, each of which have the ability to impact your investment returns. I did recently make a video on investment risk, and I do highly recommend that you go and check it out. If you're someone who hates the thought of losing even a cent, well then the financial markets probably aren't for you, because losses are inevitable. But there's no reason why you should have this attitude. Of course, you're allowed to be risk averse, but that doesn't mean you should avoid investing at the mere thought of losing cash. More often than not, the amount that you miss out on by not participating in the financial markets far outweighs the potential loss on any given trade. Of course, that's not to be taken literally because there's always the possibility of the catastrophic loss, but by educating yourself and acting sensibly, you can mitigate the chances of that type of loss from ever occurring. For example, if you don't like risk, uncertainty, volatility, and all that good stuff, then don't invest in the likes of cryptocurrency, which is inherently a volatile asset. Instead, focus your attention and resources towards researching some other investment types which may be more suited to your palate. So hopefully here at the end of the video you now have a better idea of some of the considerations that you should take on board when trying to figure out where to begin with your investing journey. Considering the factors that we discussed throughout this video will allow you to begin crafting your investing identity, so to speak, and will provide you with some guidance. Starting out investing for the first time isn't easy, and feeling overwhelmed is commonplace. So my advice would be to take your time, do your research, and first figure out what it is that you wish to achieve in consideration of who you are and where you're at as an individual before ever pressing that purchase button. And just to reiterate, the information in this video is for educational and entertainment purposes only and isn't meant to constitute advice. If you are unsure of any of the information that you've heard in this video, I would highly recommend going ahead and contacting a professional financial advisor. And please never make any financial decisions based solely on one person's opinion on the internet, such as myself. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.